Hey, if you're an entrepreneur in EU, this video is for you because here I will outline how to raise money from banks and what are the top mistakes that entrepreneurs do when doing that, right? And we're also going to share the blueprint and the frameworks how we approach as a brokerage company helping entrepreneurs to raise money. So my name is Arthur, and today I'm going to talk about the things that we have all in common as we're entrepreneurs. So we don't know how to raise money, we don't know how to do it from a banks, we don't know where to apply, how to prepare the documents, because we have all these myths, right? I'm not lendable, banks don't lend me, I took a loan a few years ago, I barely paid it back and I don't want to do that. So there are many myths, and let me outline what's in reality. So the big problem is that there's a big funding gap. It means that all the banks have all the money and they're lending it because they earn money from their interest on the loans that they lend to you. So, and we all think that all the banks are sitting on this island and you need to swim through the sharks to get there. Yes, there are too many banks and there were very high rejection rates, right? But it's because of the wrong mix. This is why we can't get to the island. So the problem is we don't know how to get there. Again, Europe has money, the capital is there, loan to deposit ratios. This is how you measure if the bank has enough lending capacity against its equity, is enough to lend all the money to all the entrepreneurs in European Union countries. And the rates are easing down because of Euribor is going down, the rates are going down, but we as entrepreneurs and SMEs are not benefiting because you don't have a CFO, you don't have an accountant good enough to do that on your behalf, right? And you don't have enough understanding and liquidity, and you are not big enough to do that, right? Because if you're big, you have like thousands of employees, you have like very high level CFO, then it's his job to raise money from banks, right? And then again, there are billions untapped. The same in European Investment Fund, Nordic Investment Banks, there are many millions there. We just don't know how to get it. And in Europe, we are lagging behind the US. So there's we calculate there's extra $240,000 per each company in Europe if we will be the same as in US in terms of the borrowing. So we need to learn that. Who am I to say about that? Well, I'm a founder and I'm a fundraising strategist for founders. So it's a founder from founder, no consultancy bullshit, no nothing. So I'm a financial expert. For 20 years, I'm in finances, starting with writing business plans as an auditor and in Ernst & Young, and I grew up to the CFO. Then I quit and I became a founder. I founded 36 companies in different vectors, wholesale, retail, manufacturing, and my main vector was in lending and crowdfunding and fundraising. So because of that, I gained enough experience and knowledge to become a fundraising strategist, and now I'm going one-to-many, so I'm sharing my knowledge and expertise we got based on 1,300 deals and 100 million raised. So we have proven results, and this is only for the successfully raised money, right? Because around 80% are rejected based on our statistics. So it's about more than 10,000 applications and totally have been through my arms of my team, of my companies, and majority of them were rejected. And you know what? There are strict patterns. We see why it's happening like that. And today you know why. Why I do this? Because money makes money. With more money, you can earn more money. You can increase your return on equity. And debt is a leverage. This is the most entrepreneurs don't get it. Second, I lived it. So I made many businesses. I did everything within the business. Made my own website, made my email marketing campaigns, ads, and etc. And I went through the bankruptcy as well. And I've carried the scars. I recovered from that, so I know the pain, the grind, and that all we have while you're listening to this, driving in car, sitting in your car, or at home at couch, or watching at 2 a.m. because you're desperate to find money from a bank, right? I've been there many times, and having zero cash in the account. And every day I see that many SMEs go out of the business because of lack of capital. So I can help to solve that. So there are many funding options you have. The best thing I advise anyone is to get money from revenue. Just buy a book of Hormozi, 100 million money models, and just start stacking up the value and converting value to the revenue as soon as possible. So you're not depending on the bank financing. In this way, you have this vehicle. So again, it's best to start with the revenue. If you did that, then you optimize the working capital. So you say that all your customers paying upfront and all your suppliers you're paying them with 60-90 days delay. This is why how you optimize the debtors and creditors, and you get the cash from the operations within the business. So if you did that, then you structure your liabilities. So you have everyone to who I am, owe money, and then try to restructure. If there is a payment graph and payment term for 1 year, I go for 2 years. If it's 2 years, I go for 5 years. This is how you decrease, the pressure on your cash flow on a monthly basis. And then you go borrow money from banks. From banks, alternatives. You do that, you have a fundraising strategy, you do that, and only then I think you need to go for equity. Because in equity, you give up your shares in return for the money. When you borrow from banks, you don't give up the shares. You give the assets, the revenue to pledge, and then you get the money. So the equity, I would consider being the last option. But then again, if you are not, the bootstrapping type of founder, and you don't have enough, energy, maybe time, maybe knowledge, maybe no money, right? And the equity is the only way to precede your company, then of course you go for equity fundraising. My job to make sure that you just understand all the options outlined on the table and you pick the best one for you. Because there are many ways how to do that. Friends, family, fools, bootstrapping. You can borrow money from them, you can go for safe, you can bootstrap. Again, then you have local banks and non-bank lenders. Then you have the government support programs. These guys are long ones. Usually the government in any country, they're long ones. Then you have alternative private credit, leasing, factoring, revenue-based financing, credit funds. Usually they are for the more scale-ups and more mature companies. Then you have international lenders who could actually be lending money in your country. And then there's equity capital. VC, strategic investors, angel investors, you name it. So the business is the odds game. So there are different stats, but I use this. 81% of new enterprises survive the first year in EU, but in 5 years, like half of them are dead. And this is just the math. And then we're reborn. If you're like founder and your entrepreneurship and is in your blood, then you're reborn, you start again, right? Like a phoenix. But what are the top 3 closing reasons? So number 1, out of the money. They just run out on the bank account, you have zero, you have no money to pay your employees, no money to pay taxes, rent, you're done. The second reason, no customers, like there's no cash flow coming in. This is what Hormozi is saying about in his book, you need to have enough customers to pay off the majority of the problems. And then the people issue, the poor team. And you know what? VC is looking for the knowledge, right, in the business. So knowing all this, what I want to say is that you can tackle out of the money issue with what we are giving you guys out of the money. If you predict, how much money you will have within your cash flow in the next few months, then you can really tackle this problem before it even happens. And then again, I want to ask you a question. Why money? So we all need money, but the question is how much money and for what do you need exactly? This is what banks are asking. Someone always double asking when talking to a customer, he says like, I need $500,000. Then my question is for what? What's the specific reason you need your money for? And again, marketing sales push. I need this amount for this ad, for this period. I need this to test this hypothesis. And off you go. You have working capital, hiring A players, growth expansion, equipment technology, inventory, supply chain, debt refinancing from higher to lowest rates, M&A by competitors, real estate, R&D, emergency buffer. So these are 11 main points why usually business needs money. Actually, you can pause this video here and write for you what kind of you need, right? Because even though you don't have money right now, you can start thinking about. This is the point B. Usually when I talk to the founders, we give master classes. First, you do the point A, where I am, what I have, what kind of assets, revenue, or zero. And then the point B, where I want to go. And then why I need money is the part of the point B. For example, I need to buy a second line of equipment. It costs 100 euros. It will be delivered next 6 months and it will help me to double my revenue in the next 1 month. Double. Okay, nice. So this is the specific goal. With this goal, I can actually go to banks. Banks all they ask is like, what's the goal? What's the purpose of the loan? And actually they don't like the purposes of refinancing or just working capital, no name, or paying off the taxes. I mean, it's doable, but they don't like it. And sometimes we get this comment like, I work only with equity. Equity is my stuff. Equity is everything. I don't work with debt. Okay, just look at the big giants. Big giants use debt. We cannot go to IPO without the debt. At some point, investors, if you have those on the cap table, will ask you to increase return on equity. And the only way it's done is by raising money from banks. So raising money is a math problem. It's a math and emotional problem. In this video, I'm tackling mostly the math problem. So let me show you an example. There's an input. You have equity, you have assets, you have revenue, you have gross margin. Actually, I can stop here and say you need to memorize these things. Equity, assets, revenue, gross margin. And you can add cycles, right? So how many cycles do you have? Every businessman should know these numbers. It's not feasible, I will call my accountant. No, you need to have more or less revenue, assets, profit, equity, gross margin cycle. Why? You will see later. And then we apply for a bank loan. Let's say bank gives me 1-1 debt equity, so it's like 1 million euros loan for 5 years, for 5% annualized percentage rate. So the question, should I borrow? You can pause here, think for yourself. So if you thought about it, mathematically speaking, the gross margin is 20%. On €1 put in, and then in one cycle you get 20%. So let's say, I don't know, one cycle is 1 year. If the one cycle is 1 year, you earn 20% gross margin. Let's say it's EBITDA margin, right? And then you pay for the money 5%. You're left with 15% profit, right? So you borrow 1 million, you had 15%, you have 150,000 euros on the top of your revenue. It's actually the profit, right? So you add it to your profit, which is in this case 400,000. You get a pretty much high increase in return on equity. So this is the example. In this example, the return on capital employed increased by 38%. Always think about when you borrow money if the margin is higher than the interest rate. If it's higher, math solves it. If it's equal, then you need to see what kind of other options, what kind of benefits it brings. Sometimes the benefit could be with more money, you can buy more goods. You can decrease price there. You can have better payment terms. With more money, with more volume, you can do many, you can finally supply to a bigger customer. So in this way, maybe the interest rate is higher than your current margin, but after a few cycles, you will kind of make it better. But if interest rate is higher than the margin, then it should be a very strong reason for borrowing the money. Because otherwise you can just lose your business. If the unit economics is negative, then you will lose your business. So one of the frameworks we teach our customers is the capital map. So on the x-axis you have not available, available. On Y, needed, not needed. So is capital available for me? Yes, no, mathematically speaking. And do I need the money? Yes, no. So parked potential. I'm a turtle. What does it mean? It means if you ask me, Arthur, do you need money? I would say no. And if you look at my numbers, I'm not fundable. Like I am not available. Capital is not available for me, right? So I'm sitting there. I don't need it. Nobody lends me. I'm good. So I have park potential. No problems with me, right? But then again, if I need money, but I'm not lendable, then I'm in a stuck position. In this case, there's a homework to be done, right? If nobody's lending me, there needs to be a reason. And this is the math problem. You go, you solve it, you go back. Because in previous quadrant, here it's an emotional problem. Because I don't need is an emotion, it's something's blocking. Something's fear of growing, fear of losing what I have, etc. Then we have rich and calm people. It depends on the country where we work, but in developed countries you can see that there are many rich and calm people. I'm rich enough, I could borrow money, I don't need to do that, I'm living on my own equity, I'm good. Okay, good for you. So you have a potential to grow, to outcompete other companies, to have more money, you just don't need that, okay, nice. And the last one is armed and hungry. Those who have capital, who can raise money, and they need that because they have a clear plan and goal in their head, what they want to do. So I like to work with these guys, I like to work with the stuck potential. The other one, park potential, rich and calm, is very, very heavy lifting because these people, these founders, usually they're stuck in their fears and their limiting beliefs, and it's very hard to unlock that, even though I'm trying my best. This I borrow from Tony Robbins, that the capital fuels all 6 human needs. So if you borrow money, you borrow for it for capital. Okay, so this I borrow from Tony Robbins. It's about when you have capital in a company, what kind of benefits it brings. So it brings certainty, right? So you have more certainty in the business, you have better planning, you have more cash buffer in your company. Then it brings more variety. You can buy more goods, you can buy better people, you can hire more better talent, etc. Then brings significance and the credibility of your company in the market. It brings more people, more connections, more suppliers. In the eyes of the bank, you look much better. And it brings growth, so you can scale better. You have more capital to really grow and scale your company. And the final contribution. More money you have, the better impact you can have on the world with better products, better services. You can do the social work. You can help charities. I mean, there are many things you can do with the money. So every time you think that I don't need money, think again. Anytime you hear anyone else saying, money is the number one, no, please guys, money is number one reason why we do business. It's about the profitability, right? It's converting my knowledge, my skill set through the value to the people, and then people pay me money back. So this is the fair exchange. And then I use that money to put it in the company again, and then it grows. So why need to make any decisions right now? I mean, you don't need to. But the interest rate cycle is going down. There are billions available for you to borrow, and fundraising takes time. From 2 to 6 months on average, it takes to fundraise debt. The key principle that I learned from one of my mentors, I remember this big guy, he has one of the biggest alcohol manufacturing holdings in Europe, and he said, Arthur, you need to borrow money when you don't need that. Because at that stage, you'll get the best terms from the banks. And I asked him, what do you do with the money if you don't need that? He said, well, any entrepreneur will know what to do with the money. For example, we buy another plant, we buy a competitor. But we do that only when we get the money, right? So it's a better negotiation position. How we work as brokers, we have brokerage companies, so our network is a leverage. We have a list of 505 financial institutions we're working with. So we have pretty much coverage most of the banks in the European Union. We work with the state-owned, private banks, local capital, international capital. We secure that across Europe. This is the few cases that we did in different countries. For example, we fundraised $500,000 for the university. Then for the food tech, it was partly debt and equity mix. And then there's a real estate developer. We have helped to raise 1.6 million from the alternative lenders. So he's building the real estate. So the blueprint is the same, right? Across the sectors, across the countries, and across the situations. So working with a broker, it could be us, you can work with any other broker as you want. It's a liquidity boost. I mean, we help you to get more capital. You get time economy because otherwise you spend months on doing that. This is not your job. Your job is to develop the business. Then you have high returns on equity. You reduce your cost for the interest rates. And you can't do this alone because you have many of these things. Nowadays you put AI there, etc. You can't do this alone, right? It's like accounting. You're not doing your accounting, right? So you outsource the fundraising to the people that know. Once we did a math and we asked how many hours people spend on fundraising, 387 hours will be the maximum for you to spend on the debt fundraising if you do it properly. If you use a broker, it takes only 46 hours. So it's a 341 hour economy. And if you earn 300 euro per hour, this is how much you would lose if you do it on your own. So how the process looks like? Usually there's a discovery call, sign NDA, we analyze the data, we present the financial strategy, what will be the fundraising plan, we sign agreement, we execute the funding. What you get in return, you get measurable gains. You get money in the account, lower interest rates, time saved, opportunity costs avoided, and access to expertise. Fundraising knowledge, extensive network, market intelligence, and exclusive blueprints and checklists we have. So again, this is everything you get. And what's next for you? So you can download our Ultimate Bank Funding Blueprint. It's a full do-it-yourself guide. You can download it, you can read it and apply it to any country, to any business you are. Or you can watch one of our recordings of a masterclass we did on the 5-step funding. This map where you are, where you want to go, what's the homework, what's the financial strategy, and just apply and win. So these are the 5 tactics we teach and founders learn, to do everything on their own, right? So watch the video, there'll be links below. Thank you for watching, have a nice day, and have an amazing business. Take care.